Welcome to Get Started Investing, a podcast where we help you learn to invest in 15 minutes or less. Each episode, we take one real-world business story and apply a key investing lesson to help you build your investor toolkit. If you're joining us for the very first time, welcome. We strongly recommend that you scroll up and start at episode 1. Before we get started, just a reminder, we are not financial professionals. We are here learning like you, and nothing on this podcast should be taken as advice. With that said, let's crack on. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Good to be back for this episode. The R word is being thrown around a lot by financial media, and I think it's time we define it, we discuss it, and we talk about how to invest because of it. During it?
Okay.
In it?
Recession.
Yeah.
Yes,
the
recession.
R word, recession.
The R word. We're going to talk today about how you can survive in the bad times and thrive in the good times. And this episode is thanks to Sharesies. For more market news and investing resources, you can follow them on Instagram at SharesiesAU or visit the Learn section on their website, which is sharesies.com.au. Links will be in the show notes. So Ren, what is the news story?
Yeah, well, the news story is the R word and what that means, because Twitter and financial news were abuzz this week as the White House reportedly tried to change the definition of a recession. Okay,
so let's start. Should we start with what the actual definition of a recession is?
Let's start with what the conventional wisdom is.
Yeah. Which is 2 consecutive quarters of negative GDP growth.
Yeah, so gross domestic product, GDP, measures the total output of an economy. And if that goes backwards 2 quarters in a row, so 6 months, that is a recession.
Yes.
Not according to the White House.
No. So the White House have come out with a statement that says, while some maintain that 2 consecutive quarters of falling real GDP constitutes a recession, most people know that is neither the official definition nor the way economists evaluate the state of the business cycle.
Yeah. Now, they go on to say, instead, both official determinations of recessions and economists' assessment of economic activity are based on a holistic look at the data, including the labour market, consumer and business spending, industrial production, and incomes. And they close out by saying, based on these data, which sounds clunky, but I guess is technically correct, based on these data, it is unlikely that the decline in GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates a recession. Now, Bryce, the timing of this is interesting because Thursday in the US, so we're recording this Thursday in Australia, so the numbers aren't out yet, but Thursday in the US, second quarter GDP numbers get released.
It's obviously political spin.
Have a guess what the number's going to be.
Negative.
Yes.
So
now look, that's the news story. Twitter was a buzz. CNBC was a flame. Turns out they're not actually wrong. Turns out that 2 quarters of GDP growth, what we've always learnt as indicating a recession, isn't actually technically right. It's just usually indicates a recession.
Right. Is there a technical?
I just looked up the Reserve Bank of Australia website and they had similar language like this.
Really?
Yeah.
They also have political spin there.
Yeah, I guess so.
I'm pretty sure since the moment I started learning economics, that was the...
Same. I never studied economics, but you've always been you tell me all the time, and turns out you were wrong.
Anyway, let's get moving with the lesson.
Okay, because I think the thing is, whatever it is, what a technical recession is, what isn't a technical recession, the fact of the matter is economic output is down, will be down. We're in a recession or in a recession adjacent period.
Yes. Yeah. If it's not a recession, it's something masquerading as a recession.
So the R word doesn't really matter whether technically we're in one or not, because really the economic environment is tough. And so the question is, how do we invest during a recession or recession adjacent period?
And the lesson is survive through the bad time, thrive in the good times.
Nice. Sounds so easy.
It is easy.
Okay.
Yeah.
Well, tell me how.
It's all about cash.
Okay.
An asset class that we often don't speak a lot about on an equities investing podcast. But in times of recession, or in times that adjacent to recessions, cash is important. It applies to our personal finances, and particularly in this case, we're going to talk about how it applies to the companies that we're investing in.
Yeah, basically in a recession, money dries up. Cash is harder to get. In the good times, cash is easier to get.
Yes.
It's not easy. It's never easy. No. But, banks are willing to lend money in the good times, and then they become a lot less willing to lend in the bad times. Interest rates are going up at the moment. Credit risks is higher. People are more likely to default. Banks are getting worried about like mortgages and can people afford their mortgages. So banks tighten the purse strings. They're less willing to give you cash, but also investors become less willing to give you cash. They become less willing to invest. They might be losing money elsewhere. They become more risk averse. They get a little bit nervous. So the money dries up. And so whether we're talking about personal finance or whether we're talking about the companies that we're investing in, it turns out many of the lessons are actually quite similar. It's all about having the cash, having the emergency fund, having cash in the bank, and then having good cash flow to get through the bad times and then allow you to thrive in the good times.
Good money habits.
And so what we want to do in this episode is build that analogy even further, really stretch that analogy, because it turns out many of the ways that we should personally think about our money, what personal finance experts tell us is really important at times like this, can actually be applied to companies as well. And so the way you think about your personal finances and the way you think about the companies you invest in actually aren't too different.
All right, so we've got 5 things from personal finance experts, Ren, on how to manage your finances during a recession, and then we'll analogize those to steps that companies should also be taking and how you can think about the companies that are in your portfolio. So the first one, you're hitting a recession, bulk up on your emergency fund.
Yeah, so this is like the classic thing, as we were researching for this episode, personal finance expert after personal finance expert, this is their first point. Always have an emergency fund. In times of a recession, bulk that up. The rule of thumb, 3 months, is that?
Yeah,
personal
3 months.
Yeah. And some of the articles I was reading say, think about how you can bulk it up to like 6 months and stuff like that. Because the logic is you could lose your job. The percentage chance of losing your job increases in a recession.
Yeah.
Well, that's what the experts tell us we should do from a personal finance perspective. Turns out companies also need an emergency fund.
Yeah, well, they should definitely take the same approach. Bulking up the emergency fund it is essentially protecting them from less business. If they're going to have less revenue coming in a time of recession, customers aren't spending money with them as much as they were in good times, they're going to need to have an emergency fund to cover themselves for their 3 months or 6 months expenses, whatever time period that they put there. And how do we measure this, Ren?
So you'll hear about a balance sheet, and basically that's it shows the amount of assets a company has, the amount of liabilities they have. But on that balance sheet, you can see how much cash they've got in the bank. There will be a line that says cash or cash equivalents, and you can see they've got $200 billion in the bank. They got $2 in the bank. In the same way that we personally should have emergency funds in case things go wrong, in tough economic times, companies need that cash buffer as well. So that's one. Do they have cash?
What if they're spending their emergency fund?
Well, I mean, is it an emergency?
I don't know. Hopefully.
I mean, yeah, look, like if a company is unprofitable and they have no money in the bank, you'd get nervous. If a company is unprofitable and they have like 10 years worth of cash in the bank, they can continue to be unprofitable, then you'd be like, all right, well, they have the emergency fund to survive through the downturn at the moment. So that's how you'd look at it.
Yeah, survival. All right, so the next one the next tip from personal finance experts on managing finances during a recession is to try to ensure that if you haven't lost your job, then at least your salary or income is as stable as possible.
Yeah, make sure your income stream is stable. That's a key thing that personal finance experts talk about. And we can think about that with the companies that we're looking at to invest in as well. is their revenue stream stable? Are the customers that they're selling to good quality customers that will continue to be able to buy their goods or services even in a recession? For example, the US government, unlikely to go out of business no matter how bad a recession gets. So a company that sells to the US government, that's a pretty stable revenue stream. On the other hand, we saw a recent example, Shopify. Shopify people talk about as a really high quality business. And what they do is they enable e-commerce businesses to set up e-commerce shops online. Really high quality business, but their customers not as strong as the US government. A lot of unprofitable e-commerce players that are struggling at the moment. And so Shopify has been struggling as a result. Not because their product is bad or their business is bad, but because a lot of their customers are struggling, and that means that they're struggling. So lesson number 2, in the same way that we want to shore up our salaries, companies need to shore up their revenue streams.
Number 3, ensure that we're spending less than we're earning. This, I think, should apply recession or no recession, but particularly in a time of recession, make sure that what you've got coming in is more than what is going out. There is no way that you can build an emergency fund and add to it if you've got more coming out.
Yeah.
Same goes for a company. Is the company profitable? I.e., are they spending less than they're earning?
Yeah, and importantly here, if they're not, so many of the companies of the last few years not profitable, but are they taking the steps to become profitable? Is that what they're focusing on?
Yes.
We saw that in Australia with the buy now, pay later player Zip. The market loved it when they said they were shutting down Singapore, shutting down some of their business units, because they were like, we're gonna do everything we can to become profitable. In tough economic times, if you're spending more than you're earning, that's a red flag. And if a company is spending more than it's earning, that's a red flag, because it's going to be difficult to get more money.
Yeah. I would caveat as well that if you do see headlines about companies you're invested in cutting costs at times of recession, don't always take it as bad news. It can be seen, like as we've just said here, they're doing the right thing in a time of recession.
Why is that a caveat?
I don't know, just because someone might be sitting
exactly
there going, I'm companies. All right, lesson number 4, paying down debt during times of recession.
This is a classic one from personal finance experts. The chance of you losing your job is higher, so don't have unnecessary debt because it's risky in times of a recession. Same with companies. They might lose key customers, their revenue might dry up. You want to get that debt off your books, so it's just not hanging over your head.
Yeah.
Yeah.
And then finally, despite all that, continue investing for the future. So continue to add to your retirement account, continue to take advantages of those low prices where you can, because life doesn't stop during times of recession. It can get a little harder. And the same goes for companies. They should still be looking to do, investing in the future and coming out thriving on the other side.
Yeah, so in your personal finances and in the companies that you're investing in, you've got to be looking towards the future. Investing by its nature is a hopeful activity. You're deferring your consumption today because you expect to have more in the future.
Yeah.
And in your personal finances and in the companies you're investing in, that's what you want to see, because the bad times don't last. And whether the White House is right and we're in a recession or we're not, or we're just recession adjacent, these bad times will not last.
That's it. Survive through the bad, thrive in the good. You want to be making sure your companies are doing the same things that you do in your personal life from a finance point of view. So a thank you to Sharesies who have supported this episode. As we said, for more market news and investing resources, you can follow Sharesies on Instagram at SharesiesAU or visit their Learn section on their website, sharesies.com.au. Ren, great lesson. Loved that one. A lot that you can apply both in your personal life and in your investing life. So we'll continue to watch the big R word and pick it up next week.
Sounds good.